All right, let's jump right in. Today we are tackling one of the most powerful and honestly one of my favorite signals in trading, RSI divergence. We're going to break down how this single indicator can actually tell you two completely different stories about what the market's really doing.
You've been there, right? You're staring at a chart, price is just rocketing up, everything looks amazing, but you get this feeling in your gut that something's not quite right, that the move is getting tired. That feeling, that little bit of doubt, is often the very first sign that the price might be lying to you.
And that's exactly where the RSI, the Relative Strength Index, becomes your best friend. I love this quote from Ezekiel 2 because it just nails it. While the price chart is showing you the big, loud, obvious move, the RSI is in the background, quietly pointing out the real story. It shows you the momentum shifts and the pressure building up right under the surface.
So here's how we're going to unpack all of this. First, we'll cover the basic idea, price versus momentum. Then we'll get into the two faces of divergence, the one that signals a reversal and the other that signals a continuation. Then we'll put it all together into a slick two-step strategy you can actually use. And we'll wrap up with some crucial rules of thumb.
Okay, first things first. We have to understand this fundamental conflict. It's really the whole idea behind divergence. It's what the price is doing versus what the momentum is saying. So the RSI is our main tool here. And look, don't get bogged down in the math. Just think of it like a speedometer for price. That's it. It measures the speed and change, the momentum. When recent gains are bigger and stronger than recent losses, the RSI goes up. When losses take over, it goes down. Simple as that.
Now, in a healthy, normal market, the price and the RSI are in sync. They agree. If price makes a new high, you'd expect the RSI to make a new high too. It makes sense, right? But divergence, well, divergence is when they start to argue. Price goes one way, but the RSI goes the other way. And that disagreement, that's our signal.
Okay, let's talk about the first phase of divergence. This is the one most people know about. It's called regular divergence. Think of it as the market's early warning system that a trend is running out of steam and might be about to turn around.
Let's look at the bullish version. So, picture a downtrend. The price is just grinding down, it makes a new low, lower than the last one, but when you look down at your RSI, it's actually making a higher low. You see that? Price is down, momentum is up. That's regular bullish divergence, and it's basically screaming that the sellers are getting exhausted. The bottom could be close.
And of course, it works the exact same way on the other side. You're in a beautiful uptrend, price pushes up, makes a new higher high, everyone's excited. But the RSI, it makes a lower high. It's not keeping up. The price chart looks powerful, but the momentum, the real engine behind the move, is starting to fade. That's a classic warning sign.
Now for the second phase, this one is a little more subtle, a little less known, but man, is it powerful. It's called hidden divergence. And while regular divergence warns you of a reversal, hidden divergence actually tells you the trend is about to continue. This is a real pro's tool.
So check this out. It's kind of the opposite of what we just talked about. We're in an uptrend, and the price does a little pullback, right? It makes a higher low, which is totally normal. But during that same pullback, the RSI makes a lower low. See how that's different? This is hidden bullish divergence, and it's a fantastic sign that the dip is getting bought up and the main uptrend is about to resume.
And again, same logic for a downtrend. The price is falling, it has a little relief rally, and makes a lower high. But at the same time, the RSI makes a higher high. This is hidden bearish divergence. It tells you that this little pop in price is weak and the dominant downtrend is likely going to take over again very soon. It's a great confirmation signal.
Okay, let's just pause and put this all together for a second. This table right here is your cheat sheet. You've got regular divergence, which is your reversal signal, and you've got hidden divergence, which is your continuation signal. Honestly, take a screenshot of this. It's the perfect way to remember which is which.
So, we have these two powerful signals, one for reversals, one for continuations. How do we actually put them to work together? This is where we go from just theory to a really practical, powerful strategy.
Here are the tools you're going to need. It's pretty simple, really. 2 time frames, like a 1 hour for the big picture and a 15-minute for your entry. The 200 EMA to give us a quick read on the overall trend. Of course, our RSI indicator, and finally, some basic candlestick patterns for that final confirmation.
So here's the magic, the two-step process. Step 1, you're on your higher time frame, say the 1-hour chart. You find the main trend using your 200 EMA. Then, during a pullback, you look for a hidden divergence. This confirms the trend is still healthy. Then, for step 2, you drill down to your lower time frame, the 15-minute chart.
Now you're hunting for a regular divergence to pinpoint the exact end of that pullback. You wait for a confirmation candle, and boom, that's your entry signal.
Okay, now before you get too excited and run off to the charts, we got to talk about the most important part, the rules. Divergence is amazing, but it is not a crystal ball. You have to trade with clarity and understand the risks. Please, burn these rules into your brain. First, divergence is about probability, not a guarantee. The signals are way more reliable on higher time frames like the 4-hour or the daily. And this one is huge. Always wait for confirmation. Never trade on the divergence alone. And of course, always use a stop loss. Markets can do crazy things. Oh, and a little pro tip, when you're drawing your lines, use the candle closes, not the wicks. It'll give you a much cleaner signal.
So, the next time you open up your charts, I want you to look deeper. Don't just follow the price. Look for that disagreement, that hidden story, that momentum is trying to tell you. Because when you can read both faces of divergence, you really start to see the market in a whole new way. So ask yourself, what story are your charts really telling you?